Assalamualaikum, my name is Nur. I'm binti Sakireli and I'm going to be the first presenter. Have you ever been curious about how a company increases their capital? Is it through debt or equity? And what are these two called? Don't worry, me and my team we got it covered. Now let's find out about capital structure theory. In this presentation, we are going to discuss about the factors and its solution, theories on determining capital structure, agency cost of equity, and signaling hypothesis. What is a capital structure? Capital structure is the special mix of debt and equity that is used to fund the company's operation and growth. The company's ownership, shares, and claims on future cash flow and profits are the basis of equity capital. Besides, it also involves the use of borrowed money, where it's called debt, to increase potential profit for shareholders, but it also raises the level of financial risk for the company. The main components of capital structure is equity capital and debt capital. The examples of equity are common stock and preferred stock. For debt equity, there are loans, bonds, debenture, and convertible debt. Next, to stabilize the capital structure of a firm, it is crucial to know about the concept, which is debt versus equity, cost and risk in financing that can vary based on whether a company chooses debt or equity and to optimize the risk. The main aim of capital structure is to strike a balance between using debt and equity effectively. Having too much debt can burden finances due to heavy interest payment, whereas excessive equity can dilute ownership and decrease earnings per share for current shareholders. The main objective of the capital structure is to minimize the weighted average cost capital, where we call the WACC. Different sources of capital debt and equity have different costs associated with them. Finding the right balance between debt and equity is very helpful. It also should provide the company with financial flexibility. This means having access to different sources of financing and the ability to adjust the capital needs according to the condition. Now, let's move to Diana to discuss about the factor and its solution.
Hi, my name is Nurdina Adila Bakri Bakri. Thanks to Ain. And let's move to my part. Do you know guys, how the factor might affect capital structure? Capital structure might affected by two, internal and external. Firstly is control. The control of that should be employed if the current shareholder desire to keep control. The company might make equity shares if they don't mind giving up control. Second is cost of equity. The financial risk that my shareholder must deal with increase as more debt is used. The required rate of return lies when the rise goes as well. Any use beyond the amount increase the cost of equity, and even though the EPS is higher, the share price may fall. Okay, the lastly is risk consideration. Firstly, the financial risk is the state is which is a business is unable to pay its financial obligation, such as interest, a dividend on preferred stock, payment, or creditor. The second about risk consideration is business. Business risk refer to the risk of the business inability to pay its fixed operation expense, such as the rent, employees, salaries, if insurance premium. Next, we move to external effective capital structure of three types of external. Firstly, market condition. Market condition is the pattern of capital is also influenced by prevailing market conditions of investor to purchase share, interest rate, stage of business cycle, tax, risk of investment, and together from market conditions. Next is competition. Competition means the firm which are facing capture. Competition prefer to issue equity share because their earnings are not certain and adequate. By the companies which has monopolies may issue the equity because constantly of earning. Lastly, of external is attitude of investor also plays an important role in the determinant of capital structure. The investor was ready to take risk and expect returns prefer equity share for investment. On the contrary, conscious investor who are interested in the safe and equal income invest in debenture. Next, we move to decision-making process is how a company goes about making decisions regarding its capital structure. Three types of the consideration that drive this decision-making process. Firstly is cost of capital. Cost of capital means companies must strive to find a capital structure that minimizes the weighted average cost of capital WACC. WACC considers the cost of both sides about the debt and equity to arrive at a balanced cost of capital. Next assess a company leverage and risk profile. A high DE ratio indicates heavy radius of debt, which can raise this amount of investment. Lastly is tax consideration. Tax consideration in assesses debt can lead to a situation where the company pays more or less than it comes on the tax. Companies need to find the optimal tax level to minimize the tax benefit. Next, to move the objectives that drive the decision-making process. Firstly is maximize shareholder value. This means the ultimate goal is to value for shareholders. Companies strive for the capital structure that increase their stock price or return on equity. Lastly, it is maintain financial flexibility. The having a healthy mix of debt and equity allows the company to adapt to changing circumstances. They may need to raise additional capital quickly, and a balanced structure provides options. That's all from me. Let's move to Afi.
Provision number 2 is depends on 3 factors. Factor number 1, the rate of return on the firm asset. RA. Number 2 is the cost of debt of the firm. Number 3 is the firm debt per equity ratio. Second is static
Next, we move to agency problems and cost of equity. A company decision of capital structure somehow can trigger problems to agency. First and foremost, the capital structure decision is a decision that a company makes about how much debt and equity to use in order to fund its operation and expansion plan. Now, let's talk about the agency cost of equity. It refers to conflicts of interest that arise between different stakeholders within a company, particularly between shareholders and the management of the company. Agency problems arise when managers prioritize their own interests over those of shareholders, leading to agency conflicts. Investors, aware of this risk, demand a higher cost of equity. In a sense, the presence of agency problems tends to boost the cost of equity, as investors seek a higher return to offset the perceived risk of managerial misalignment with shareholder interests.
Hi, Assalamualaikum. My name is Nadia. Thank you, Diana. I will present about the signaling hypothesis. Number 1 is the firm capital structure is optimized where the marginal subsidy to debt equal to marginal cost. So we talk about the investor view debt as a signal of firm value. Firm with low anticipated profit will take on a low of debt. Firm with high anticipate will take on high level of debt. Then I will talk about a manager that take on more debt than is optimal in order to hold investor will pay cost in the. I will explain about conclusion, cost of financial distress, firm to raise 3 main issue. The first is direct cost, lawyer and accountant fees. Number 2 is indirect cost. The first is impaired ability to conduct business, incentive to take on risky project, incentive to under-invest. Then number 4 is incentive to milk the property. There are 3 techniques that to reduce this cost are to protect. First is protective convenience. Second, repurchase of debt prior to bankruptcy. Third, to the ratio of the application is triggered that short term is about because past financial distress can be reduced but not eliminated. Firm will not finance entirely with the next slide, the conclusion. Debt to equity ratio vary across industry. The factor in target DE ratio fluctuates. If operators rate higher than bondholder tax rates, there's an advantage to that. Two is that asset. Cost of financial distress depend on the type of asset the fund has. Number three is uncertainty of operating income. Without the tax, firm with uncertain operating income have high probability of experiencing financial distress or forming of a part of us. Our group